Max Keiser, looking here, 4 or 5 years of austerity measures have failed to stimulate the European economies on a whole. How can economies be stimulated and then create jobs at the same time if there's a global slowdown occurring? If you agree with the fact that there's a global slowdown.
Well, let's look at the case of Ireland for a second. A few years ago, the Irish public debt was virtually non-existent. Then one of their banks, Anglo-Irish, ran up debts that were 10 times the country's GDP. They went bankrupt, and the Irish government decided to move those debts or guarantee those debts onto the balance sheet of the citizen. And then they started imposing austerity measures to bail out Anglo-Irish Bank and their unsecured debtors. So this pattern is what we've seen play out all over Europe. You've got these debts that were incurred by banks. They can't pay the debts, and the governments are doing the bidding of the banks by transferring these debts to the public and then imposing austerity measures. We saw it in Argentina. Citibank was in Argentina back in the late 80s, early 90s, or late 90s to 2000, and they went bust, basically, and the government forced the citizens to pay off Citibank's debt. So that was the model. So this is a common theme. Now, until you do something about these transference of bank debt to the public, you're going to have these problems continue. It's playing out all over the world.
Well, you have to remember that all we're seeing right now is no change of policy. We're just seeing new innovation, new products, new ways of banks essentially finding new markets for their debt, or central banks finding new markets for their debt, or European banks finding new markets for their debt, because all we're doing is perpetuating a system where we have to increase our debt in order to survive at the moment. Because as Max said earlier, we're just transferring banks finding markets for their debt and then secured by the government, and then the government trying to find a new way of bailing out the banking system. And all we're doing is we're just playing this domino effect, and then we're coming up with new innovation where the countries that are in trouble are bailing each other out, and soon we'll be asking Ireland and all sorts of other countries to bail our systems out, because we're all in this together, just perpetuating the system, and we need to look at the root cause of the problem, and we're not doing any of that.
Well, to follow up on what was just said about finding new markets for debt, to fine-tune that a little bit, they're finding new ways and innovative ways for the banks to sell debt back and forth to each other without having to increase their reserve requirement in any way. In fact, reduce their reserve requirement. So you have a bank like Deutsche Bank with $3 trillion in debts that is supported by less than 1.5% of Tier 1 capital. So you have less than a 1 or 2% fluctuation in the value of those assets, and the bank is technically bankrupt. These banks in Europe are technically bankrupt. Their balance sheets, if you were to freeze frame them and forensically look at them, you would find that they are without any collateral whatsoever. They're only supported by the illusion of whipping these debts around in the washing machine that is the euro money laundering system to keep themselves going. And like, for example, they introduced the European Stability Mechanism. This just means that the same debts that were swapped amongst banks 6 months ago are being swapped again into a new lending facility that's collateralized by the same banks. This is the very definition of a Ponzi scheme. This is what put Bernie Madoff in jail. And this can continue on additionally, because what will happen is that once they establish a European-wide central bank in Brussels to mimic what's happening in Washington, D.C. with the Federal Reserve Bank, and then once that game runs out, then the Federal Reserve Bank and this new European central bank in Brussels will create a new global central bank. And they'll do the whole thing over again. And then everyone who's suffering austerity today will have to pay additional tax to this new global central bank. So the people suffering austerity are going to continue to suffer austerity, except their tax burden is going to continue to go up substantially. And the bankers who make money creating this Ponzi scheme will continue to suck wealth out of the system and lord it over in this neo-feudal model as they've been doing now for the past 5, 10, 20 years.
Max Keiser, but in between the lines here, it would be positive to see what actually are on the books of these different banks. Are there hidden costs? Because it seems like, for example, with Bankia, when we hear about the bailout that they needed, do these countries know how much their banks have on paper in terms of assets, in terms of funds, before they can reach out and bail them out? Or are these debts going to all of a sudden surface in the news that they owe this much more? If you can elaborate on that more for us or give us examples.
Well, no, they don't know how much debt these banks have. It's part of what's called the shadow banking system. The shadow banking system in America is estimated to be over $16 trillion. So it's in excess of the entire GDP of the United States. And this is true throughout the world. There's $800 trillion in derivatives that are part of the shadow banking system. The entire globe GDP is, call it $50 trillion. What happens is that when banks want to get more laws passed to deregulate the system, to make it easier for them to continue this Ponzi scheme, they suddenly flash huge debt that they said they just found, they just discovered it. Hank Paulson did this in 2008. Dick Fuld did this at Lehman Brothers. The Troika did this when they were talking about Greece. They have trillions of dollars worth of debt that they can use as a scare tactic to get the citizens and the government to sign off, as was the memo of understanding with Greece, with the Troika. And then when they sign it off, they suddenly say, okay, well, this new lending facility is going to take care of this debt. We're going to lower interest rates again towards 0%. Of course, so the debt service is down to as low as it possibly can be. But I want to follow up on a point of Simon Dixon about the nature of money itself. Most people assume that a bank takes in a deposit and then they loan that deposit out, and this creates liquidity in the system. That's false. In today's banking system, banks first lend money into existence. That's where money comes from. It's loaned into existence as debt. A small fraction of that ends up on another bank's balance sheet that they then call collateral. But it's just debt. There is no hard collateral. That's why at this time around the world, there's a mad scramble to try to reclassify gold as a tier 1 asset, because that's the only unimpingible collateral that you can have at this point to solve the fact that none of these banks have any collateral that's worth anything in a resale market. They are all technically bankrupt. And this is what they discovered in Iceland, which is why they had to let the 3 banks, the major banks, collapse. The currency collapsed, the economy collapsed. But now they're growing again because they went through that moment. They realized that they had this huge problem. These banks in Europe have to understand that they must allow the banks to crash and let happen what's going to happen. But until that happens, there's going to be more debt servitude, more problems like we're seeing, more austerity, and more social unrest. There's a real risk now that some of these bankers are going to be rounded up. In the mainstream media in America, Nobel Prize-winning economists and people like Nouriel Roubini are suggesting that bankers should be hung. You know, I said that on this show 3 years ago, and people thought I was being, exaggerating. But now Nouriel Roubini is calling for bankers to be hung. So this is a